Welcome. I am Kelly Kuennen, and this is my partner Cameron Miele. We're the managing directors at Ellsworth Advisors. And today we're going to give our third quarter update for our 401k plan participants. Cameron, you want to start us off with some economic numbers?
Sure, Kelly. Hello, everybody. Hope everybody's well out there. I don't think you can look at the third quarter without really looking at where we've come from this year. So if you think about it, we started hearing grumblings about COVID in January and February, and then in March, obviously things got serious. We had, significant lockdowns on a state-by-state basis, and basically saw the economy second half of March come to a halt. Second quarter, we were basically closed down the entire time, and now at the third quarter, we're seeing a resumption to some level of normalcy. So if we look at U.S. GDP. And this is from the U.S. Bureau of Economic Analysis. GDP is really the measure of the overall domestic economy and the performance there. In the first quarter, GDP was down 5%. That's 5% on an annualized basis. Started off all right, had that March disruption, took GDP negative, and then really in the second quarter when we had a complete shutdown, we saw the largest ever contraction in GDP at 31.4%. Annualized contraction. Now, obviously, coming from a record low and getting back to some sort of normalcy in the third quarter, you'd expect a significant rebound. So right now, we don't have third quarter GDP numbers, but the forecast, according to the Atlanta Fed's GDP Now model, which is kind of recognized as the gold standard for predicting GDP, they're looking at a 35.2% annualized increase in third quarter GDP. So from a record contraction to a record expansion, kind of sums up this COVID-19 year for us. So, we're seeing a lot of good numbers. We're seeing a lot of bad numbers. We've seen unemployment come down significantly. So again, this is U.S. Bureau of Labor Statistics. Total non-farm payroll employment rose by 661,000 in September, and the unemployment rate declined to 7.9%. Now, we hit a high unemployment during the COVID period of 14.7% in April, and now we're down to 7.9%. So really, this shows, I think, the resiliency of the U.S. economy. Now, we have seen in August and September, and we expect in October too, somewhat of a slowing of hiring, but at least we're still hiring. Right. We're not contracting.
The trend is still intact.
The trend is still intact. Now, if we look at earnings, this is interesting. We've got record GDP, we've got people getting back to work, but third quarter earnings are still expected to be significantly down. So this is according to FactSet. For the third quarter of 2020, the estimated earnings decline for the S&P 500 is 20.5%. So a 20.5% decline in earnings. If 20.5% is the actual decline for the quarter, it will mark the second largest year-over-year decline in earnings reported by the index since the second quarter of 2009, which was a negative 26.9%. Obviously, second quarter of 2009, we're talking right in the middle.
So that's a drop from second quarter to third quarter is down?
Yes.
Not from previous year?
Not from previous year, down from second quarter to the third quarter. What's interesting is earnings are down, yet as I think everybody has seen, the stock market continues to do quite well. So valuations, the forward 12-month price earnings ratio for the S&P 500 is 21.9. This PE ratio is above the 5-year average of 17.2 and above the 10-year average of 15.5. So again, I think it shows a couple of things. People are getting back to work in the third quarter. We're returning to some sense of normalcy. People who were at home were still spending. People weren't going out. They weren't going out to dinners as much. They weren't driving their cars as much. They weren't going on vacations. But man, they were spending in online shopping.
Right.
So I think, what we've seen with the stock market, what we've seen with the rebound in the economy is we've just seen the resiliency of the U.S. economy. We've seen, really the globe's strongest economy coming back. And a lot of that, I think, is due to the consumer and due to savings that the consumer has put in their pocket over the last couple of quarters. And I think now we as a society, we like to spend. So we're seeing that spend. I fully expect in the fourth quarter, I think this is going to be a really strong holiday year. It's going to be a really strong retail year. I think there are a lot of people that were on vacation or didn't take vacations, and they're saying, all right, well, let's have a great holiday season. Let's spend, let's spoil the kids. So just in terms of the fourth quarter GDP, I've seen projections ranging from a 1% growth to a 7% growth. Obviously, stimulus has a large impact on that. It looks like we might be getting closer to a stimulus package, which could put another $1.5 trillion into the U.S. economy that'll help boost GDP. So, it's going to be an uncertain if that bill gets through and what the magnitude will be in the areas that it'll go help. But, I do expect that something will be done because something needs to get done, especially if you look at the airlines, the hospitality industries, if you work at unemployment benefits rolling off. I think both houses, both sides of the aisle really realize that something has to be done. I think something will get done.
Right. I think that'll be important. The stimulus definitely helped us second and third quarter, kind of replaced a lot of the lost income in second quarter. So that helped a lot. Fourth quarter, right now the estimate's 1% to 7%. I think it'll be a positive quarter, but definitely not the acceleration we saw third quarter in GDP growth. Haven't seen any annual estimates yet, or more recent annual estimates. Early annual estimates for 2020 would be a 5% contraction from 2019, with third quarter being stronger than expected. Maybe we're looking at 2020 being down 3 to 5% from last year, which you don't see very often.
But all in all,
it
from
could
what
have been
we've
a lot
just gone
worse.
through.
And there's definitely a lot of work to be done. The economy's been split so much; it's definitely not a 50-50 split where a big segment of the economy, especially publicly traded companies, they've been able to get through this just fine. A smaller segment of the economy, but something that is more that we see day to day, restaurants, travel, airlines, those types of businesses are still live entertainment are still seriously impacted.
Mm-hmm.
And I guess from a market standpoint, fortunately, they make a small part of the market. Not a lot of publicly traded stocks there that we've invested in, so we've been able, we haven't continued to feel that pain. But the reality is there's this segment that still needs that propping up.
Mm-hmm.
That $1.7 trillion is going to help, but unfortunately, a lot of that's going to areas that don't necessarily need the help. Market continues to chug along, and the big picture signs, but there are definitely some areas of pain that who knows when we're going to come out of that, and it really comes down to what happens from a virus standpoint.
Yep.
When does the vaccine? When do we get a vaccine? How do the treatments look? When is the economy going to be allowed to open up again? So those are the big challenges ahead of us. From a market standpoint, and Cameron kind of touched on this, third quarter, so July, August, September. July, August, 2 good months for the stock market. September was definitely a give back. And throughout all that, what we've seen is inside the market itself, especially when you look at the S&P 500, which is more broad for large U.S. company stocks, is what we look at. What we've saw this last quarter, especially in July and August, were the 5 biggest stocks in that index, which are weighted the heaviest. Mm-hmm. So they have the most influence on the index. 6 of these stocks, they kind of drove the performance in July and August. They turned around and gave it up, a lot of it up in September. And those 6 stocks are the familiar names we know: Facebook, Amazon, Apple, Netflix, Google, and Microsoft. They've driven anything because their businesses weren't adversely affected by the virus. Cameron threw something out there.
And if anything, spending on technology was up significantly.
Yeah, it would have gone up from a communication standpoint. That's replaced some of the in-person stuff. But Cameron mentioned price-to-earnings ratios, which really determine if stocks are expensive or cheap, relative to where they normally trade. And he threw out a number of 21 times earnings. That's a pretty high number. It's above averages. If you looked at those 6 stocks that I just talked about, they're even higher. You're talking well into the 30s, even into hundreds, into the thousands from a multiple standpoint. So those 6 stocks have gotten very, very expensive. The rest of the market, if you take those 6 stocks out of the market, the S&P is probably down 3 to 4% for year to date versus it being up over 4% because of those 6 stocks. So the market in general, when you take away those 6 hot stocks, is kind of where it should be based on what the economy is going to kind of be for the year. If the economy is down 3 to 5%, right now the market's down 3 to 5% without those 6 hot stocks. okay, that kind of makes sense. So in general, the market's not really, way overvalued. A segment of it definitely is. We have to be real conscious of that because we've seen this in the past, back in the late 90s, 2000, 99, 2000, 2001. This is the same type of dynamic we saw, where at some point valuations will matter, and stocks can't grow to the sky. I remember that term being thrown out there back in 1997, 1998.
We learned a good lesson then.
The guy that threw it out there was absolutely correct. Is that going to happen next month? Is it going to happen in 6 months? Who knows? We just don't know that. So diversification is definitely important. You don't want to be over-concentrated in those areas, because people who got over-concentrated in the hot stocks, when things eventually turned, it took them a long time to get back to even. It took 6-7 years to get back to even, versus if you're more diversified. I remember seeing clients that were back to even within 2 years. So when that day is coming, who knows? I'm not saying it's coming tomorrow, but there will be a day of reckoning at some point in time. When we talked about the markets for the quarter, the S&P 500, which I was just talking about, for the quarter was up 7.93%. Year to date through September, up 4.09. So the S&P up 4% for the year. The Dow Jones, which only includes one of those 6 stocks, which would be Apple, for the quarter was up 7.95%, but year to date is still down 2.93. On the international front, where a lot of participants have money, when you're diversified, you have both U.S. and international. In the international developed markets for the quarter, the MSCI EAFA was for the quarter up 4.02%. Year to date through September still down 8.92%. And then the MSCI Emerging Markets Index for the quarter was up 8.03%. Year to date still down 2.93. So U.S. still outperforming on a relative basis. But on the international side, we talk about valuations. On the international fronts, valuations definitely do look a little bit more reasonable. Mm-hmm. So once again, the key is diversification. Don't get over concentrated in just those hot stocks. That could cause some problems moving in the future. They were expensive in July. They're still expensive now, even after a weak September. They're still highly priced. And once again, you have to look at your 401k, your balance in there, as a long-term investment. Now with the election coming up, things are probably, we're going to see volatility around the election. Who knows what happens on November 4th, if it's a contested election, which will cause market volatility, mm-hmm. or not. I mean, I think that's the biggest risk. I don't think studies have shown it doesn't matter whether it's Donald Trump or Joe Biden who gets elected. What will cause problems is if it's a contested election. We saw it with Bush and Gore.
Yep.
Hopefully it's a quiet aftermath. We'll see on that. But the biggest mistake you make is to try to trade around the election, especially in a 401k plan. Once again, it's long-term money. You have to look at what is your time frame until retirement, and also remember once you are retired, that's not when you spend all your money. Is that first day of retirement?
Right.
You're looking at another 20 years beyond that. So you're looking at a long-term horizon, and the key is time being in the market, being diversified in the market. Yeah, you want some liquidity, some in the safe areas in bonds or the stable asset account, so that that'll temper the ups and downs. But in general, think about the long term, and anything that's happening now, 10 years from now, is not going to be that significant. 15 years from now, not that significant. The market will be higher.
And it's important to remember, too, that you're investing tax-efficient dollars. So this really is the best mechanism for savings. So our advice is always to make sure, if you're going to put dollars away, make sure you're maxing out your corporate retirement plan, because those are the most tax-efficient dollars. Those are dollars where hopefully you're getting a match. As Kelly said, those are long-term dollars. So, basically the message is, when people try to time the market, or when people get scared and they go to all cash, they make the wrong decision.
Correct.
So what we're trying to stress to everybody is, we're going to see volatility. We've got a Supreme Court battle. We've got an election, potentially contested election. We've got earnings. We've got COVID-19 news. There's going to be some headline risk. We're going to see some whipsawing in the market. But please don't panic. Know that this is a long-term investment. You should keep putting dollars in with your regular paycheck as much as you can. And if there are concerns, if you're not feeling good about things, if you just want to hear a reassuring voice, or you just want to have some questions, feel free to give us a call.
One of the big, when you give us a call, one of the things we're going to ask you a lot of questions around your big picture, and the key is, where does this fit in the context of your overall financial picture, your overall financial plan? And once again, probably the biggest thing, because there's going to be a lot of attention around the election and potential risks with the market. Do not make knee-jerk reactions. People made a lot of mistakes back in March of this year, and they definitely regret having stepped away because of doomsday, end of the world. This election's not going to be doomsday. It's not going to be the end of the world. And the trajectory of where we're at is definitely on the positive. We have a positive trajectory. We'll be coming fits and starts, absolutely. And once again, diversification is key. Do not get too concentrated in the winter or on the hot stocks right now. That could cause problems. But be diversified, be exposed, and try to hang in there. It's the long-term approach. That's where your growth is. You're not going to make anything in bonds or the stable asset, but it provides stability.
So if you have any questions, please feel free to reach out to us. We appreciate your trust. Thank you very much. We'll talk to you again in the fourth quarter.
Thank you.